In this week's update, the Fed pivots to a slower pace of tightening. A short-term opportunity, but medium-term for most stocks to remain challenging. And a strong week for precious metals and other commodities. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. And as I've been pointing out now for many weeks, this is a market where it's easier to lose money than it is to make money. And so the need for clarity about what you're doing, I've been doing this 35 years, has never been greater in my mind. All right, let's start with the market perspective. Peak inflation, the story that everyone's been hoping to hear, is getting clearer and clearer, and it would appear that we're getting much closer to the finish line in terms of the inflationary cycle than we are to the start. So that story keeps getting stronger and it's getting greater acceptance. The Fed's preferred parameter for monitoring inflation and the economy is what's called the PCE deflator, which is personal consumption expenditure. And that's slowing both in the short term and also in the medium to longer term as well. So these are all encouraging signs. They don't guarantee anything. There can always be a wages breakout or something of the like, but it's becoming less and less likely. And the latest data certainly confirms the October CPI as well. So it would appear, and there really shouldn't be any surprise here, that what the Fed has done all year is now starting to actually manifest itself in the data. And there's always a lag, and that's why people have been calling on the Fed for the last 3 months, just to slow it down, to let that lag show its face. But the Fed seemed hell-bent on a very, very aggressive course, and it would appear now from Jeremy Powell's comments that they're backing off that a little bit. Also, just on Friday night, the jobs data shows that the jobs market is just starting to weaken a little as well. So this is all better news for the stock market. My overall feeling at the moment is, I read very, very, very broadly from many, many sources, and my gut feeling is that it just feels like it's time that the bear market, the negative sentiment has run long enough. It's washed out the excess that needed to be washed out, and it's just time for a turnaround. Now, there still are some questions, which I'll get to, but I will make the point, as I've made all year, if you're looking at the indexes and making your decisions around those, then you've caught the wrong bus. You really need to be very sector focused, very sector specific, and even more so, I'm seeing even greater divergence within sectors now. There's huge divergences. The strongest stocks, even in strong sectors, are doing far better than others in that sector. So it's not just a matter of picking a sector and buying anything. There is still a terrific case to be made for being very stock specific. The other thing that's changed too is that the market behaviour, particularly in the last week, the market behaviour to what would be perceived as bad news, for instance, something that might cause the Fed to have to raise rates at a high rate for longer, that seems to have changed significantly. The jobs data came out on Friday night, and it was, as you would expect, the market dipped significantly in the open, but then it fought back really well. And a lot of stocks, particularly in the sectors and industry groups that I'm interested in, a lot of those stocks finished on their session highs, either just a little bit down or some of them even finished in front. So there definitely is a change in the character of the market to news that all year has really spooked the market and caused a sell-off. So that's another behavioural change that's significant. Now, last week, just for the record, XLC, which is communication services, which is one of the 3 or 4 main aggressive sectors in the US, that was the leader in terms of percentage gain. But as you'll see from the chart, it's coming off a low base. XLE, which of course has been the champion all year, was actually the worst performing. It actually fell very, very slightly last week. But look, that's normal. When you start to see a market turn around, naturally money that's been flowing to the energy sector all year, some money's going to come out of that sector to try and bottom pick in other areas. So there's nothing untoward in that about the energy sector. On an industry group basis, copper did really well, coal did well, gold did well. They were the outperformers. And the lithium majors weren't too untidy either. American stocks, the S&P added 1.1% for the week by the Friday finish. Managed to finish above the 200-day moving average, and whilst that doesn't add a lot of value to me, a lot of technical analysts get excited about whether the index is above or below the 200-day, and it does. It does cause a degree of follow through buying or selling. So just for the record, it is back above the 200-day. It hasn't been there for quite some time. Now, the falling US dollar is certainly helping, particularly US stocks that have got very significant overseas earnings. That's been a headwind, the dollar rising. The dollar has now fallen about 12 cents on the cross rates against the basket. So that's that's a big fall, and that is certainly helping the translation back to earnings. So on balance, I think you'd have to expect a positive finish to this year. Call it a Christmas rally, whatever you want to call it. And history shows that when it's been a very negative year, as this has been, that November and December do tend to be pretty solid most of the time. Not every single year, but most of the time. So to expect a positive finish is almost a bit of a given, really. The US dollar index 104.68, as we'll see on the chart in a minute. The 10-year yield was lower to 3.49. That's come off quite a bit, as we'll see. The VIX also dropped under 20 for the first time in quite a long period. But the 10-year, 2-year spread continues to widen. It was 0.74 last week, now it's 0.77. So, recession is pretty much a given as well. All right, let's jump in and look at some individual charts. So we'll start first of all, we'll look at the yield. So let's take a look at this. It just popped up a little bit over the weekend. But let's look at the 10-year yield over the last 6 months. So really strong rise from around 2.5 in July, and we got up to 4.25 in October. So it's a very steep rise. But you can see how much we've come off since then. So certainly the bond market is indicating that we're much closer to a point of peak inflation. This is the VIX index. Again, let's look at this let's look at year to date. So we're really back down to the lows that we saw in April, and of course also at the start of the year. So a very big shift in expectations around volatility. And finally, this is the 2-year, 10-year spread, and it just continues to fall. All right, this is XLC, so this is communication services. You can see very, very big response on Wednesday after Powell made his comments, and this was one of the biggest gainers on Wednesday, and in percentage terms, but coming off a low base, still got a lot of work to do. 200 days still clearly down. So this is not a sector that excites me, even though it was the leader last week. It hasn't even broken out of its base yet. So this is energy, completely different picture. We can see here, these just a fraction, and energy should continue to be a pretty productive sector. But again, you want to be trying to focus on limiting your short-term risk by buying more significant dips. And this is the XLB, which is the overall materials sector. So this incorporates a number of things, obviously copper and coal and gold. Also has got aluminium in there, and a few other bits and pieces as well. But a very strong week for materials. All right, so let's have a look at the S&P. So you can see just popped up on Wednesday and then was able to hold it on Thursday and Friday above that 200-day moving average. I'm not sure of the significance of that. I would much prefer to be looking at the spread charts, which we'll get to in a minute. But there's the Nasdaq, still lagging the S&P, but a good week. And you can see some very good volumes, particularly on Wednesday, but volumes maintained very strongly on Thursday and Friday as well. So let's get to the spread charts. This is a really important one for me: semiconductors versus the S&P. And again, this is the ratio. So line rising means the semiconductors are doing better than the S&P, even though they might both be rising. Bit of a consolidation week, but some significant outperformance before that, and it really held on to those gains. So that's a pretty encouraging looking chart to me. But we still have lower highs and lower lows. So we're not out of the woods yet. We really need to see this ratio get back above this point here. So certainly still some work for semiconductors to do. And supply chain issues with regard to semiconductors are still, very uncertain because of the US, banning the export of semiconductor chips into China. So there's all sorts of weird and wonderful moves going on in that sector. Consumer discretionary versus staples hasn't really done much yet, and that's certainly Amazon and Tesla has been weighing on that. Amazon and Tesla were the reason that this outperformed for so long, and they're the reason now that it's underperforming in a very different market environment. Russell 1000 growth versus 1000 value, not a lot of change, but certainly some consolidation. So these spread charts aren't screaming at you that that money is flowing back into the very aggressive sectors. But then bear in mind this is a very big picture overall look. When you start to get down into the individual sector level and into the individual industry group level, then you can see a very, very different picture. There's certainly clearly very strong money flows into some parts of the market. Mid caps versus the S&P, again, just really going sideways. And finally, on a weekly chart, this is US large caps versus large cap growth versus value. I guess all you can say about this is that it stopped falling for the moment, but again hasn't really turned around. So these charts are what really underpins my view that you don't want to be focused on the index. You want to really drill down and get to the heart of where the money is flowing. And you just can't get that sense by looking at the index. And finally, this is the Nasdaq 1000 versus the S&P. Now, there's one other thing that I want to do. So I want to look a little bit more in depth at the Nasdaq. So this is the QQQ. So this is the ETF that tracks the Nasdaq. So a couple of things that I want to cover here. The last 2 weeks of gains, and we've had a good solid couple of weeks from about here when we started to move more robustly, and you can see we've got some good volume spikes. And the days that the market is falling, the volumes are lower, and the days that the market is rising, generally the volumes are up. So that's a good sign, and we're seeing the accumulation distribution line starting to turn up as well. There's about another 15 to 20% in in the index needed to get up to this resistance level. So, that in the short term, I think that's why I say that I think there's the potential for some short-term outperformance. But once we get up near this resistance level, I would expect that perhaps the pressure might come back on again. But look, the last couple of weeks of gains, I thought I'd try and break it down and make a bit of sense of it from a fundamental point of view, rather than just look at it from a purely technical view. So the last 2 weeks of gains have been driven by the hope for a rate slowdown, and that is getting stronger. It's seasonality is important. November, December, typically two of the strongest months of the year, and particularly so when you come off a weak year. Thirdly, markets were very oversold, and so there was always going to be a bounce back, even if the fundamentals didn't necessarily support it. The S&P earnings growth is beating expectations. However, the expectations were pretty low. Analysts had reduced earnings growth expectations to around about 4%. So it's not hard to beat a low bar, so I'm not getting too excited by that. However, there is plenty of evidence now starting to come through that earnings are slowing and the forward estimates are waning. So, just beware of a couple of things. First of all, any stock that misses the market expectations is going to get smashed, really smashed. So you want to be very confident about the earnings growth coming through for the stocks that you own. The next thing is that the market leadership is changing. The leaders that came out of previous significant market moves, particularly out of the COVID crash, I don't think are going to lead this time. I think we're seeing evidence that the leadership is changing, and also there's an increasingly large divergence within sectors, and that's why I think it's so important to zero in, find out the strongest stocks within each individual industry group. It's very easy to do in America. It's harder to do here. We just don't have the tools here. So the big question for me, from a fundamental point of view, is how much of the earnings weakness that is now starting to come through, and we're going to get further analyst downgrades. I'm pretty confident about that. How much of that has been priced in? That's the question. And no one knows, for sure the answer to that, because, it's all a bit of a game of projections and forward estimates. So if there is inadequate amount of earnings downgrades priced in, then the indices are going down again. So again, we come back to this really, really important point. You've just got to be very, very clear and confident about what the particular stocks you own are likely to do. Now, this is the QQQ. So from the peak in December last year, you can see we've got a downtrend channel. We fell out of that downtrend channel on a couple of occasions. We got oversold. We got a bit of a bounce. That bounce in June was weak, and so we fell again, formed a lower low, again fell outside the channel, got significantly oversold, and then we bounced. And guess where we bounced to? The top of the channel. Got rejected from there, and you can see the rest of it. And we're now back to the top of the channel. Now, we can always get a little bit of an overrun to the upside and then fail. So just because it breaks out of here doesn't guarantee you anything. But what we want to see is we want to get outside this channel. We want to get above the 200-day moving average. The volumes are encouraging. This is encouraging over the last 3 sessions, the fact that the volumes were up. And the volumes were up here on the up, and also here. So higher highs, higher lows. We're poised to break out of the channel. We're being supported by good volumes. So this is a fairly constructive looking chart for me, and that's why I think we're more likely to see a positive end to the year than otherwise. All right, currencies, US dollar has fallen quite a bit. As you can see, we're 115. We're now back down into the 104s, so that's come off quite significantly. The Australian dollar has gone up, but not by as much as the US dollar has come down. So that US dollar weakness, certainly quite a bit of that is against the euro and against the yen. It's to a lesser degree against the Aussie dollar. So we finished at 67.3. So that's where we sit at the moment. So just on the Aussie Stocks, 67.31. Our index gained slightly more, 1.5 across the week. I think the important thing in the Australian market is to stay focused on the medium-term strength, the sectors and stocks that are doing the best, the ones that are, clearly got megatrend tailwinds, and use the dips to advantage. If you're a short-term trader, you can buy short-term dips, but if you're a longer-term person and you don't like too much downside once you enter into something, then just wait for a bigger dip. Your money doesn't have to be in the market. It can be sitting in cash. If it's there for a strategic reason, then absolutely fine. All right, precious metals. Gold was up $42, broke through 1,800. Finished just slightly down on Friday night. There's plenty of work to do, but it's looking a lot better, as you'll see. Translated into Aussie dollars, 26.71, so still very profitable for Australian gold producers. GDXJ has renewed its uptrend on a global basis, so sentiment is definitely shifting towards gold and gold stocks. But Aussie stocks had a very, very good week. It was a very encouraging week for gold stocks. Sorry, wrong one. Okay, so let's just have a quick look at the ASX 200. So this has done very well. I mean, we're probably closer to all-time highs. So there's the all-time highs. We're probably closer to the all-time highs than any other major index around the world. So this has been a pretty good performance. Certainly led by energy and materials, but also finance has done pretty well also. Silver has had a very good week last week. You can see Wednesday, Thursday, Friday very strong for silver and a really robust breakout. This is gold daily. Really nice move Wednesday and Thursday, as obviously a part of that is the US dollar, so the direct currency impact. But there is also a move back into gold now that the market is sensing perhaps peak inflation is not too far away. Cooled off slightly on Friday, but nevertheless a good week. And if we look at it on a weekly, you can see we're right back up now to the next support level. So this is looking better. And if we look at GDXJ, again we're back into uptrend. We've got higher highs and higher lows, and we've made a breakout, and we're also back above the 200-day. Volumes not terribly exciting, I must say, at the global level, but there certainly are. There's been some very, very good performances in Australia, which of course members know very clearly about. Other commodities, copper was up to 3.71, but nickel really got a surge on and finished at 12.66. Crude oil also bounced back from the mid-70s, got back up to 80 and finished pretty much on the high of the week. Partly US dollar declines, partly associated with this proposed cap on Russian oil. So there's the copper chart. So we're starting to look better there on copper. Copper inventories still at pretty low levels. There's nickel, a really nice spike up there in nickel, and also we're trading at pretty low levels on the LME nickel stock level as well. Wrapping it up, as I said at the start, I just sense, it's a bit of a gut feeling call, but I just sense a bullish tone. into year end. The commentary around the world is shifting, and certainly the big event of the week was the comments from Jeremy Powell. Australia remains very much a stock pickers market. It really does. And the need for, and I know I keep saying this just about every week, and some people might get a bit bored with it, but there's always new eyeballs on this video. So the need for a clearly thought out individual plan has never been greater, because as I said at the start, I think it's easier to lose money in this market than it is to make money. I really do. You can do extremely well, but you've got to be very focused and you've got to have a very clearly thought out plan to do that. Portfolio analyst last week covered a lot of ground, utilising the strongest parts of the market, which is what I've been talking about today. How do you actually go about doing that logistically? We looked at some non-mining targets just to see what else is out there, rather than getting too top heavy in mining stocks. And there certainly are some good opportunities. Not a lot, but there are some good ones. We also looked at an early stage, but very much world scale copper opportunity for the long term. This is one that you'd want to be thinking sort of 3-4 years time frame, but the potential upside is very significant. Now this week coming up, as we do once a month, is a skills building session. So anyone that hasn't had a look at Portfolio Analyst, it would be a good week if you're looking more for general development of skills, as well as all the recommendations and the Q&A that we have in Portfolio Analyst. So 2-week trial, $1 is still available. All right, that's it for this week. More information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.